gold, Bitcoin, these kind of scarcer assets that can't be printed, for example. I think those are the best defense we have against what's happening. A bull run right now, but it's still a tiny percentage of global assets compared to, I think, what his total addressable market it is. And I think it's in large part because it's very hard for the Fed to tighten when public debt is this high, and when any tightening they do adds to so much interest expense, which ironically is stimulative. It's fiscal deficits pouring into the economy. It's very hard to have a recession when you're running $2 trillion deficits. You're pre-stimulating before the recession even arrives. And of course, that comes with consequences.
Lyn Alden begins by addressing the traditional 60/40ths portfolio, which typically consists of 60% stocks and 40% bonds. This portfolio thrives in environments characterized by low inflation, cheap commodities, low consumer price index CPI, and low interest rates. However, in periods of high inflation or rapid currency debasement, Alden suggests incorporating a hedge of real assets. These include energy exposure, infrastructure, gold, and Bitcoin. Such assets are scarce and cannot be printed, offering the best defense against inflationary pressures. Alden notes that gold has performed better than expected, given the positive real interest rates and balance sheet shrinkage. She highlights the year 2022, where net liquidity fell and asset prices across the board dropped. Yet, towards the end of 2022 and into 2023, despite the Federal Reserve's attempts at tight monetary policy, fiscal dominance led to liquidity measures rising. Consequently, stocks, Bitcoin, and gold prices increased, and real estate rebounded to previous highs in the United States. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
When we think of like the 60/40 portfolio, it's mostly assets like stocks and bonds that prefer disinflation. They prefer cheap commodities, low CPI, low interest rates. That's how their valuations get high. If you go through a period of inflation or more rapid currency debasement, I think you want to add to that a hedge of real assets. You know, things like energy exposure, infrastructure exposure, gold, Bitcoin, these kind of scarcer assets that can't be printed, for example. I think those are the best defense we have against what's happening. You know, in the prior cycle, the tech monopolies have kind of been the best thing to own, things that, you know, are hard to replicate. And going forward, you know, a lot of them are now, you know, multi-trillion-dollar assets. Their upside is still probably somewhat limited compared to where it was 5 or 10 years ago. And I think so going forward, you know, the asset that I still see has a lot of promise is Bitcoin. But I would never put all my eggs in one basket. So it's basically anything that has scarcity to it and that is not already very crowded in terms of the amount of capital that can be in there. So for example, the big US tech stocks, they're very crowded. Americans have a lot of exposure. Europeans have a lot of exposure to the US tech stocks. Kind of the whole world is pretty heavily focused in those. Whereas the areas that they're not in are things like energy producers or even Bitcoin. You know, it has like a bull run right now, but it's still a tiny percentage of global assets compared to, I think, what his total addressable market it is. So I look at what is scarce and what is not over-owned. And at least, you know, I might not want to be all in those assets, but I want to make sure that they're added to a portfolio that otherwise consists of traditional assets and maybe overweight those types of assets. I mean, we've seen this with gold as well. It held up a lot better than you'd expect based on the positive real interest rates and the shrinkage of the balance sheet. I think basically a lot of things behaved as you'd expect in 2022. That's when net liquidity was falling quite a bit. Asset prices across the board were pretty much falling. But what started to happen towards the end of that year and into 2023 is that even though the Fed was trying to be tight, they were no longer being as tight as they expected because of the fiscal dominance we just talked about. Money was coming out of the reverse repo facility and back into the broad money supply, even though they're trying to be tight. And so most measures of liquidity have been up since then, even though they've continued holding interest rates high and they've continued reducing their own balance sheet. Other measures of liquidity are coming in. And so you see stocks up, you see Bitcoin up, you see gold, still like holding its own. Real estate, it corrected a little bit and is back up to its highs in the United States on average, at least outside of the bubbly cities. Like you look at the nationwide average, it's kind of back up to the highs. And I think that's in large part because it's very hard for the Fed to tighten when public debt is this high, and when any tightening they do adds to so much interest expense, which ironically is stimulative. It's fiscal deficits pouring into the economy. It's very hard to have a recession when you're running $2 trillion deficits. You're pre-stimulating before the recession even arrives. And of course, that comes with consequences. That, we risk having a second inflation wave. We risk furthering, asset prices going up faster than wages, keeping people locked out of the housing market, locked out of, the stock market. And so I think that that's still a thing that it's going through. But I think more and more institutions and large entities are kind of realizing the long-term fiscal problem. And they're saying, I'm not going to hold Bitcoin just as a zero interest rate play. I'm going to hold it because I don't see any way that the US government's not going to inflate their way out of this. And so you see people holding Bitcoin and buying Bitcoin despite the fact that interest rates are over 5%. Fiscal dominance.
Okay.
People debate between a hard landing or a soft landing. I like to describe it as an emerging market landing. If you see how recessions go in emerging markets, often stocks are nominally up, because the currency is so weak. And it's a very different type of, when the economy is kind of interesting there, it's different than kind of the deflationary developed market economy. And what we're seeing now is some of the developed countries are approximating what happens in developing countries on a more regular basis. And that's because so much public debt has built up on the ledger. And so if you go back, for example, to the 1970s, there's two major sources of money creation. One is bank lending, so fractional reserve bank lending, and the other one is like large monetized fiscal deficits. And back in the 70s and 80s, for example, the rate of bank lending was very high because the baby boomers in the United States were entering their home buying years, and there's a lot of credit creation. And so there's a higher than normal amount of lending. And there were deficits as well, but the lending component was much bigger. The year-over-year money supply increase from lending outpaced the deficit. And public debt was very low. It was 30% public debt as a percentage of GDP. And so when they wanted to slow down inflation, their policy was to raise rates super high because that slowed down the rate of bank lending. And although it did increase the public interest expense as well, that was a smaller factor because the debt level was so low. So it held down private sector stuff more than it kind of led to government inflation. And so that was successful. I guess the dark side of it is also they crushed a lot of emerging markets that had dollar-denominated debt, especially Latin America at that time. And so they reduced their oil consumption by basically causing a depression, which alleviated the oil price for other places, including the United States. So that's kind of the dark side. But a couple of things have built up over those decades. So one, public debt is now 120% of GDP in the United States compared to 30%. So it's 4 times higher. The other factor relating to that second one about, say, Latin America is that the United States has run decades of consecutive trade deficits. And the rest of the world takes those deficits, and for them it's surplus, and they reinvest those into U.S. assets. So if the dollar spikes and it increases the power of their dollar-denominated debt, a lot of countries have a lot of assets that they can sell to, protect themselves from that. And so the ricochet hits the U.S. market a lot more readily than it did 40 years ago. And so now we're in a stage of fiscal dominance, which is the annual deficit that happens is larger than the sum of all bank lending. And even the sum of bank lending plus new corporate bond issuance, right? And so if you increase interest rates in a similar way they did in the 70s and 80s, if you try to increase interest rates to slow down inflation, ironically, although you do slow down bank lending somewhat, you increase the deficit by a larger amount than how much you've reduced bank lending. And that means that the central bank effectively runs out of tools to address inflation. They may be able to address it for a short period of time, but then it starts catching up with them. And I think that's what they're in now. They're finding that their tools are not as effective, and that higher interest rates are in some ways risk being pro-inflationary, because for all those interest expense that the government's paying, there are people on the other side of it that are receiving it and able to spend that into the economy. And so I think we're on the other side of the looking glass, where we have fiscal dominance and this kind of a more like literal debt spiral. It's not as quickly or as high magnitude as you see in an emerging market, but it's directionally similar. It's kind of a slow motion fiscal train wreck that's playing out. And that generally means that nominal prices are going to be higher than you expect. Nominal GDP growth is higher than you expect. And crashes, instead of prices always crashing down, the currency's slowly crashing up. So they're kind of meeting halfway. Some assets, if they get in a bubble, they consolidate, they go off. But also the currency's rising so much that you have to be very mindful of the denominator you're thinking of these assets in.
Bitcoin's adoption is indicated by its price and liquidity. Despite its volatility, Alden sees this as essential for its growth from a $0 to $1 trillion market cap in just 12 years. She believes Bitcoin will continue to climb in terms of total adoption, potentially becoming a multi-trillion-dollar network, larger than any individual stock. The network effect is vital, with various Bitcoin hubs worldwide, such as Bitcoin Beach in El Salvador and Bitcoin Jungle in Costa Rica, contributing to its health and growth.
Bitcoin is globally portable, censorship-resistant, self-custodial money. At least if you have the option to self-custody it. And even compared to other cryptocurrencies, it's the biggest, most liquid, most secure one. So if you want to send $1 billion, overseas, Bitcoin's the one that can handle that kind of volume. And then there's network effects associated with that. The bigger it is, the more liquid it is, the more secure it becomes, which then makes people want to own it even more. And so price is an important indicator of adoption. It doesn't matter what happens on a 1, 2, 3 year basis, but certainly over, say, rolling 4-year periods, you want to see higher highs and higher lows in Bitcoin, because that shows that adoption is happening. And like you said, volatility is important because what you want when an asset is small is you want upside volatility. You can't go from Bitcoin currently is worth about $1 trillion market cap, a little bit above that. And it went from 0 to $1 trillion in, something like the first 12 years it hit $1 trillion, then it was in a bear market. So now it's back to $1 trillion. You can't get that without upside volatility. And with upside volatility comes leverage and comes over-enthusement for a period of time. And that's what creates periods of downside volatility. So it can't get to whatever its total addressable market is without both directions of volatility. Now, once Bitcoin gets closer to whatever its total addressable market is, so for example, you think, what percentage of your liquid net worth do you want in a portable, like a globally portable, self-custodial, peer-to-peer money, like the best one? Probably a pretty significant percentage of like a liquid net worth. And right now, very small percentage of people even own any. The people that own some usually have a small percentage. And so I think it's still climbing in terms of its total adoption. I think eventually it's a multi-trillion-dollar network. I think it'll be bigger than any individual stock. And so until it's at that kind of higher mature phase, I think the volatility is going to be present. And as far as the overall Bitcoin, kind of the health of the Bitcoin network, one of the biggest ways I measure it, one is price and liquidity, but also it's kind of the network effect of the people involved. So all the different hubs that pop up. One of the first ones was Bitcoin Beach in El Salvador, and they eventually inspired the whole nation to kind of adopt it, or at least at the president level, and kind of slowly put it out to the rest of the country. Then we've seen, for example, Bitcoin Jungle in Costa Rica, Bitcoin Ikasi in South Africa. There's all these different hubs popping up, and we're in a hub right now, which is Bitcoin Atlantis. It's a good name because you're in an island, Madeira,
I love it,
in the middle of the Atlantic Ocean. But what happened was a few years ago, a bunch of Bitcoin enthusiasts really kind of focused on this jurisdiction and said, let's create a little bit of a Bitcoin density here. That's what we're seeing play out now. That now, compared to a few years ago, from people that have been here during that time, a lot more merchants accept it. A lot more people hold it than they did a few years ago. And that's what you see in these different little hubs around the world. And so I think that as these hubs grow, that's healthy for the Bitcoin network. You don't want all the Bitcoins to be in one big BlackRock ETF. You want to see the Bitcoins kind of spread around to all these different jurisdictions, all these different countries. The thing that kind of makes me most optimistic is when I go to these conferences. I was talking to a woman from Saudi Arabia. I was talking to a man from Bolivia, another man from Colombia. There's a whole group from Bulgaria, someone from Australia, someone from Malaysia. A bunch of people, of course, from the U.S. and every part of Europe. Many people from Africa, people from the Middle East, and just everyone's here kind of in the same sort of shared vision. And then a lot of them go back and they're building stuff at home. They're building communities, they're building companies, and that's part of the network effect. That's part of what makes it eventually get up there as being one of the biggest monetary systems in the world.
These hubs create Bitcoin density, increasing merchant acceptance and individual holdings over time. Alden expresses optimism about Bitcoin's future, highlighting the global community's shared vision and efforts in building communities and companies around Bitcoin. This network effect is crucial for Bitcoin's eventual rise as one of the world's largest monetary systems. Please like and subscribe my channel.